Welcome to Market Brief After Hours. It has been a fascinating week in the financial world, with risk appetite remaining incredibly firm. We are seeing major U.S. benchmarks pushing to fresh record highs, largely driven by a relentless tech rally. Investors seem to be looking right past lingering geopolitical uncertainties. To break down exactly what happened today, let's dive right into the numbers. Can you walk us through the major U.S. indices and how they closed?
Absolutely. The overarching theme today was definitely a rotation into technology, and you can see that clearly in how the major indices diverged. Let's start with the S&P 500. It climbed by 0.80% to close at a fresh all-time high of 7,023. That benchmark is on an absolute tear, posting gains in 10 of the last 11 sessions and up about 3% for the week.
And the Nasdaq is following a similar trajectory, right?
Even stronger, actually. The Nasdaq Composite extended its winning streak with another record close, advancing 1.59% to finish at 24,016. That marks its 11th consecutive session of gains, adding nearly 5% this week alone. Persistent strength in semiconductors and large-cap tech is really underpinning this move. Broadcom was a massive standout, rising 4% after Meta Platforms extended its partnership with them on custom chip deployment.
But it wasn't a clean sweep across the board. The Dow seemed to be the odd one out today.
That's right. The Dow Jones Industrial Average actually slipped. It fell 0.15%, or about 72 points, to close at 48,464. It really lagged behind the broader market because the gains we are seeing are so heavily concentrated in technology-led sectors. But it's worth noting that even with today's slight decline, the Dow is still up more than 1% for the week, which tells us the wider market tone remains very constructive.
It really highlights that selective risk-on environment. Now, looking across the Atlantic, the tone in Europe was noticeably different. We saw some significant pressure over there. What drove the European markets lower?
It was a tough session for Europe, largely dragged down by weakness in the luxury sector. The Pan-European Stoxx 600 fell more than 0.4%, and most major countries finished in negative territory. In the UK, the FTSE 100 dropped 0.36%. France took a bigger hit, with the CAC 40 down 0.65%, and Switzerland's SMI lost 0.38%. Germany was the lone bright spot among the major bourses. The DAX 40 managed to close marginally higher at 24,067, holding on to some momentum from a strong recovery the previous day.
You mentioned luxury being a drag. How bad was the damage in that sector?
It was severe, particularly in the French market. Kering tumbled 9.3% after Gucci sales completely missed expectations. Hermes also took a heavy hit, falling 8.2% as currency fluctuations really cut into their revenues. Other major players like LVMH and Christian Dior moved lower as well, adding immense pressure to the sector.
Aside from the corporate struggles, there was some interesting macro data out of Europe too, right?
Yes, the macro picture was a bit of a mixed bag. Eurozone industrial production unexpectedly rose 0.4% in February, which beat expectations of a decline. However, inflation is accelerating in parts of the region. France saw its annual rate rise to 1.7%, and Greece climbed to 3.9%, mostly driven by higher costs for energy, housing, and transport.
Speaking of energy, oil prices had a wild ride earlier in the week, but seem to have stabilized. What is the latest there?
Oil was relatively flat today after a sharp 8% drop in U.S. crude on Tuesday. Markets are growing hopeful that diplomatic talks between Washington and Tehran could ease Middle East tensions and prevent a deep supply shock. U.S. crude settled at $91.29 per barrel, while Brent closed just 14 cents higher at $94.93. Analysts are also noting that potential crude production disruptions in the Persian Gulf look less severe than initially feared.
And before we take a quick break, we should touch on the U.S. domestic economic data. We had numbers on import prices and homebuilder sentiment. Did they give us any new clues about the economy?
They did. U.S. import prices rose 0.8% in March. That was actually well below the 2.4% spike economists were expecting. It was mostly driven by a jump in petroleum prices, but non-petroleum imports barely moved, rising just 0.1%. On the housing front, things look a bit bleaker. Homebuilder sentiment fell to a 7-month low in April. The NAHB index dropped to 34, missing expectations. Buyer traffic is down, and 36% of builders are cutting prices just to move inventory. Affordability pressures are still heavily weighing on housing demand.
It is a complex picture. Booming tech stocks on one hand and struggling housing demand on the other. We are going to take a short break, but when we come back, we will dive deep into the currency markets, check out those crucial moving averages, and look at the single stock stories making massive moves today. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange markets. It seems like the US dollar is seeing some varied action against its major peers. Can you break down the key currency pairs and what the technicals are telling us?
I would love to. Let's start with the euro against the dollar. Euro USD closed at 1.1799, up a very modest 0.03%. It posted a bullish candle, holding near session highs. From a technical perspective, the price remains firmly above its key moving averages. It is sitting above the 50-day simple moving average at 1.1673, the 100-day at 1.1697, and the 200-day, which is also clustered right around 1.1673. Those moving averages are providing an incredibly strong base of support right now, favoring further upside as it tests resistance around 1.1808.
And how is the British pound holding up?
Very similarly, actually. GBP USD held firm, closing at 1.3571, up 0.04%. The bullish structure here remains completely intact. The pair is trading comfortably above its moving averages. The 50-day is at 1.3428, the 100-day is at 1.3441, and the 200-day is at 1.3414. All three are aligned in a bullish configuration. The trend is well supported by a consistent pattern of higher lows, which shows there is underlying demand every time the price dips.
What about the Australian dollar? I understand we saw some significant multi-month highs there.
We did. AUD USD had a fantastic session, breaking higher to close at 71.74, up 0.68%. It produced a strong bullish candle, confirming a breakout into levels we haven't seen in months. The moving averages here are clearly aligned for a bull run. The price is well above the 50-day SMA at 70.35, the 100-day at 68.75, and the 200-day at 67.04. Immediate resistance is right around today's high of 71.77.
And looking at the Japanese yen, the trend there seems quite established as well.
Exactly. USD JPY closed at 158.98, up 0.13%. The uptrend is very strong. The price is well above the 50-day SMA at 156.88, and it's sitting way above both the 100-day and 200-day SMAs, which are both clustered down at 153.3. If it breaks resistance at 159.15, we could easily see it target the 160.00 level.
Let's touch on gold before we look at individual stocks. It seems the precious metal is facing some headwinds.
Yes, short-term weakness has definitely emerged. Gold closed at $4,795, down nearly 1%. It formed a strong bearish candle, signaling a continuation of a recent corrective move. It has actually dropped below its 50-day moving average of $4,899 and the 100-day of $4,684. However, it is still holding above the 200-day moving average at $4,176. So the broader, long-term uptrend is technically still intact, but we are definitely in the middle of a short-term pullback.
That is a great technical breakdown. Let's shift gears to the equities side. We had some massive individual stock movers today. DoorDash really caught my eye. What was the catalyst there?
DoorDash shares surged a massive 10% today. Barclays put out a note identifying the company as a primary beneficiary of autonomous delivery technology. The market loved it. In fact, it even lifted their competitor, MapleBear, which gained 4% in sympathy.
Speaking of big gains, Robinhood markets also shot up. What is the story behind that move?
Robinhood climbed 10% following news that the SEC approved sweeping changes to day trading restrictions. The market views this as a massive win for Robinhood, as easing those restrictions is expected to significantly boost trading activity among retail investors, which is their core user base.
On the flip side, Live Nation Entertainment had a very rough day.
They did. The stock tumbled 6% after a federal jury ruled that the company held an illegal monopoly over the live event sector and had overcharged consumers. That kind of regulatory and legal pressure is exactly what investors fear, and they hit the sell button hard today.
Finally, Micron Technology saw a bit of a slide. Was that related to the broader tech sector or something specific to the company?
It was company-specific. Shares declined 2% following a regulatory filing that revealed an executive vice president sold off $10.1 million worth of stock last Friday.
Executive selling often spooks retail investors, even if the broader semiconductor sector is performing well.
Taking a step back and looking at the big picture, how would you summarize the current market environment?
The current backdrop is heavily biased toward momentum-driven positioning. Investors are continuing to pour money into growth sectors, specifically tech, despite the uneven performance we are seeing across different global regions. The resilience of the U.S. equity markets is impressive, especially when you consider that Treasury yields are moving higher and economic signals, like the housing data we discussed, remain mixed. The 10-year yield is up to 4.279%, yet the market keeps climbing.
Is there a risk to this kind of market behavior?
There is. The leadership is narrowing. We are relying heavily on a handful of mega-cap tech names and specific sectors to pull the entire market upward. That makes the market much more sensitive to any sudden shifts in sentiment. Upcoming data releases and policy signals from the Fed are going to be critical. The big question is whether this rally can broaden out to include other sectors, or if the momentum will eventually face a period of consolidation. For now, though, the trend is your friend, and the trend is pointing up.
It will be fascinating to see if that momentum can sustain itself without broader participation. Thank you for walking us through all of that data today. It is always great to get beneath the surface of the headlines. If you find this useful, please follow Market Brief after hours.